Hello, I'm Stephen Hammond with Christian Values Investing. Today I have with me Grayson Shaw. And Grayson, so many times I get emails from different organizations and they're always touting great investment ideas. Man, if you invest in this, if you invest in that, you get all these great returns. And one that I noted that came in today was saying two particular high dividend stocks that you can buy at retirement, and basically you can put your money into these two stocks and you can ride off in the sunset and live happily ever after. You know, Grayson, if investing, and especially investing for retirement, was that easy, everybody would be doing it. So Grayson, let's dive into this email that we received. It says that one of the funds that you can put money into is the SPE Special Opportunities Funds. And what they're saying that is you can invest in these two funds, and if you were to invest $100,000, you could get $7,500 annually off each one of those $100,000 investment, which is a lot more than what we recommend on the 4% rule. So what I want to do with this is I want to look at the first chart, if we can get it pulled up. It is a chart on the SPE Special Opportunities Fund. And what you realize when you're looking at this fund, it has been kind of volatile over the last 5 years. You know, in the last 5 years, what we have had interest rate shifts where interest rates were going down, then all of a sudden inflation started hitting and inflation started going up. So the Federal Reserve had to start taking action and they started raising the rates. And so what you notice with this fund is that it has actually went down almost 40% from where it was before the rates started going up. And you notice that this is probably pretty much too volatile for so many people that are at retirement age and they're just wanting to put their money away right off into the sunset. This may be a little bit too volatile for them at paying 7.5%, but it's got the potential to fluctuate 40%. So Grayson, I believe many investors, what they don't realize is that going forward with the United States debt at $36 trillion, that we're going to be in an environment where interest rates are going to go up and down over the next 10, 15, 20 years. And you could be where you lock in into a fund like this with no maturity date on it. You could have great volatility in this where your investment could go up or it could go down quite substantially. And usually for investors we talk with that get retirement age, instead of taking more risks, they want to take less risks. And usually an investment like this is not a very good fit for people that is retirement age. They could put some money in it, but you wouldn't want to put all your money into this particular fund. Do you have anything, Grayson, you would like to add to that?
Well, kind of like what you were just saying, for your retirement portfolio, this might be suitable for a portion of it, but definitely not all. Because as you can see in both of these charts, there are big-time fluctuations when you see interest rates start coming up. And if you're 70 years old and you're living off of this income, you don't want to see that cut almost in half. That'd be pretty bad.
Grayson, let's look at the other chart, and it's on the John Hancock Financial Opportunities Fund. If you could get a screenshot up with it. And what you notice with this, under the same time period, it's had fluctuations of almost 40%. And so when interest rates are going up, these particular funds get very volatile. And this is what has happened. You notice that it's paying a decent dividend, and they have performed okay, but they are volatile. So I think this particular fund kind of almost fits the same shoe as the one before. Grayson, is there anything with this fund that you would like to add that we hadn't already covered with the other one?
Yes, this BTO fund has to do with the financials industry and the banking industry, and so it particularly experienced some volatility back in that time period when there were some questions about Silicon Valley Bank and some of these other companies that were dealing with the consequences of their own actions and basically taking on too much risk with their clients' money. So they were bullish during that time in the industry, and some of that may have paid off. They have done about twice as well as the previous fund that we looked at, but still, it is important to notice that it is very volatile, just like the last one. Having a portion of your money in this might be fine, but going all in, especially with it just being one sector, is going to be very, very risky for anybody, not even just somebody that's retired.
You know, another red flag for both of these funds are the expense ratio that is involved. They're way higher than normal, and that should show a red flag to you. What you want to do when you're looking for a dividend fund or dividend paying stock, you want to find ones would have very small management fees, expense ratios, instead of ones with very high expense ratios. So in a nutshell, what you need to do if you're looking for a dividend stock, a dividend fund, is what you want to do is you want to get in and do your research. You want to look for a company that has paid dividends for a very long time, that have a track record of increasing their dividend from time to time. So as inflation takes hold, that the dividend amount would go up on a regular basis. You would want greater dividends as inflation takes hold. So you want to look for companies that are increasing their dividend amount on a regular basis. But always, when you're looking for money to invest in retirement, or if you're just having money set aside that you want to invest, always do your due diligence. Always study the charts. Look at the expense ratios, who's managing the fund, are they a long-term money manager, and make sure you dot all your I's and cross all your T's before you invest your hard-earned dollar into a company that you end up regretting somewhere down the road. Grayson, is there anything else that you would like to add before we close this meeting off today?
One more thing is that investing seems easy, kind of like what you were talking about at the beginning of this video. It can look really easy when you read some of these articles. So all I have to do is buy these couple of funds. All I have to do is invest in treasuries right now. All I have to do is time the market and get in at the right time and get out at the right time. And that can sound really easy, and it can sound appealing to people, and honestly, it can make you think you're going to do a lot better than you will. But when you get in, if you're not disciplined, if you don't know what you're doing, if you don't understand that there are going to be times when the market takes a hit and you don't know how to deal with that, sometimes it'll be very difficult for you to manage your money. And that's when having somebody that knows what they're doing can really come in handy for you, and being able to trust them to know what they're doing in the thick and the thin and the highs and the lows is an invaluable asset that you can have.
Very good advice. Until next time, may God richly bless you.